Hello and welcome to interest.co.nz. I'm Gareth Vaughan and I'm here with John Kensington, the Acting Head of Financial Services at KPMG. KPMG has just produced their annual FIPS report, review of the financial and the banks and the finance companies for 2010. Now, John, it's an interesting report as ever. What's in your sort of overall summary of what you found this year?
I think, Gareth, the main thing would be deleveraging. All sectors of the economy have deleveraged, and by that we mean they have tried to repay debt. And indeed, if they've been able to do that successfully, they may have repaid ahead of the schedule and also may have made some savings. So that was the number one finding. That's shown up in the way that banks' lending opportunities have decreased and new loan growth has actually been very much, it's been level. I mean, year on year, the lending books are level. The second impact that we've probably had is a large body of regulation coming in. Here, I think most industry participants believe that regulation is required, but I think what they're saying is it's an awful lot coming at once when we're also having to deal with the back end of the global financial crisis.
And that deleveraging, I mean, obviously that was a key word during 2010. It's still out there now. I mean, we're still seeing a lot of that going on, and lending growth is still pretty anemic across the board. Is that what you're seeing?
Yeah, it is, Gareth. You're absolutely right. And what's caused it is that towards the end of last year, there were some early green shoots, as people call it. The economy started to pick up. And you need to remember that through the global financial crisis, a lot of New Zealand businesses got a real fright. A lot of households got a real fright. What they saw was their equity disappear in their business, or the same in their home. And so coming out of it, with things starting to look a little bit better, they became very cautious. Just as things were picking up, there was the first Christchurch earthquake. Then there was a very slow retail at Christmas time, and probably around about now there should have been the beginnings of the government infrastructure projects kicking in, and in particular the rebuild of Christchurch. But the second earthquake has stopped all that in its tracks, and people are still very, very nervous, and they are deleveraging, and that can be repaying loans or in fact saving rather than spending.
And that earthquake, I mean, obviously that's having a huge impact in Christchurch and around the country, across the whole economy. For banks, what do you think it's going to mean overall?
I think the first thing it's going to mean is, and banks will be well down the track to doing this, is working out what their initial exposure is, and that'll be well in place. But then the difficult thing will be, what is the secondary exposure? What is the flow-on effect? Will Christchurch rebuild exactly where it is? Will it rebuild to the extent that it does? Will businesses come back to the extent that they have? I think in the long term, 30 years down the track, there'll be a Christchurch. It's just what happens in the interim, and the banks will have an iterative process as they look at their impairments, as they look at where they get their new lending as Christchurch is rebuilt.
And now look, it sounds like as you've gone around talking to all the banks that there's a little bit of grumbling about compliance costs. There is obviously a lot going on in that area. We've got the Basel III coming in internationally, the open bank resolution policy from the Reserve Bank coming in, many other areas, the new Financial Markets Authority that they'll be paying levies for. I think one of the figures in your report was a third of IT expenditure is going on compliance among the banks. So there is a bit of grumbling about how much that's all costing.
I think there's a healthy tension at the moment between the banks and the regulator. The bank's view is that they do have to make a profit to give a return to their shareholder, and then they also have to be able to innovate to make new products for their customers, and particularly as we are hopefully at the end of the recession and we're going into a new cycle where things are on the up, they'll want to innovate and make new products. What they're saying is that this regulation is good in a sense, but it's all come at once. The regulator's view is that, well, we had a global financial crisis and we need to do things right now to make sure that our economy is in good stead should we have any further downturn, whether in the immediate or near future. So I'd describe it as a healthy tension, yeah.
And look, the rural sector is always a key one in New Zealand, obviously. Still high levels of debt out on the farm. One of the interesting things that we are expecting to hear about in the next month or two is whether the Reserve Bank brings in some new tighter capital ratios on rural lending. What are you expecting there, and what impact might that have?
Well, I think what's happened historically is when farm returns, the Fonterra payout, for example, has been up, farmers have taken that as an opportunity to expand their business. And I think when that expansion happened last time, it was very much based on land prices. The amount to be paid was based on land prices, perhaps opposed to what the economic unit was producing as cash flows. And so a lot of farmers went out, bought more land, became bigger farmers, but did so with debt. And when there was a bit of a dip in the commodity prices, that caused some of those farmers to be quite stressed. Now, where we are at the moment is that sector of the economy is very much two-speed, if you like. There are some farmers that have managed to repay debt and are now looking quite strong and are probably at a time now where they will be thinking about purchasing another farm because they've paid down debt and they're in a good position. But like I mentioned before, everyone's had a bit of a fright over this crisis and they're being very hesitant about doing it. There are still some large farms, corporate and otherwise, that have extensive amounts of debt. And I think what the Reserve Bank's saying is that's not healthy for farmers in such a key sector of New Zealand to carry debt based on ballooning prices. The amount of debt they have should really be based on the cash flows that they can service from their farm.
And so, if we do see these tighter capital controls come in, I mean, that could be a bit of a break on the rural sector?
I think it could be a bit of a break on the rural sector, and it could increase their cost, their interest cost to do business a little bit. Yeah.
And look, one of the other areas that's been of great interest in the last couple of years is the Reserve Bank introducing the core funding ratio, the big push for more domestic funding and less reliance on the offshore hot markets. Now, what your research has found is that in the last year, the overseas funding has only gone down by 1% among the big five banks to 34%. Yeah. So it's not much of a move given that push by the Reserve Bank, is it really?
No, it's not. It is a move in the right direction after all, but I think it probably comes as people start to deleverage. The first thing they will do is repay debt. The second thing they'll do is when they have excess money is put it on deposit. So perhaps there's been a bit of a lag. The first part of deleverage was probably about repaying debt. The second part, and you may see it going on into 2011, is more locally sourced deposits.
And look, just in terms of the bad loans and the impairments obviously coming out of the global financial crisis, how are they looking now?
Well, interestingly enough, the level of impaired and past due loans has increased 2010 versus 2009, but the level of provision against them has decreased. And what that's really saying is there are still loans out there that are troublesome to the banks. There'll be a core of loans, but they are probably getting a little bit better as the economy improves, and while they're still being watched and will still need to be managed, they are gradually improving.
And what about the profitability in terms of the return on equity and the net interest margins? How are they looking?
Okay, well, looking at net interest margin first, that's been very flat. In fact, it's decreased slightly. And that's because of the fact that the lending book hasn't grown. Obviously, if a bank wants to grow its net interest income, it needs to either grow the size of its book or improve its margin. The bank's lending has been very flat in this period. They haven't been able to improve their margin. In fact, it's been decreased because of the pressure for funding. In terms of profitability, though, they have seen a strong growth of profitability. Now, this comes off a very, very low point. 2009 was an all-time low level of profitability for the bank sector. It's increased, but it hasn't increased because of net interest income growing. It's increased because the banks have had less impairment charges to take as the quality of their books have improved. And it's also increased because this year we don't have some of the big charges coming through the P&Ls for the tax conduit cases. In terms of capital adequacy, or equity if you like, the sectoral position has improved, and that's a result of profits being made and finding their way down into retained earnings. It's also slightly to do with some specific capital injections by some of the parties, and the risk-weighted assets have reduced slightly. So all in all, they've made a better profit. Their equity's a bit stronger, so they have done very well.
And look, finance companies obviously another part of your annual survey. There are less of them again, but I guess the numbers haven't dropped by as much as maybe in the couple of years previous. But what's the future for the finance company model, and especially funding for finance companies?
I think those are two very interesting questions. The finance company model going forward is going to be what is loosely referred to as the new paradigm. There is much greater regulation about taking money from the public, and those companies that are there now are typically foreign-owned, well-supported companies, or companies that have been there for a long time. I think you need to appreciate the companies that have departed the sector were ones that were established and grew very quickly on the back of the property boom, and so when there was a property decline, the opposite happened.
Well, thanks for that, John. That's John Kensington, who is the acting head of financial services at KPMG, talking about KPMG's latest financial institution performance survey. And I'm Gareth Vaughan at interest.co.nz.